The primary objective of the strategy we are analyzing today is highly specific, capturing high-efficiency momentum extensions into price discovery on the Micro E-mini NASDAQ 100, or MNQ. We are not looking to trade the noise, crashing blindly into early volatility. We are looking for the exact moment the market commits to a direction. The most common failure point for developing traders is the early New York Open. When you rely on technical indicators in isolation, the volatility of the morning session will routinely chop you out, forcing you to take losses in a directionless market. To filter out that early session noise, we apply a specific, strict framework known as the triad of momentum. This framework requires the absolute alignment of three distinct pillars: technical bias, structural triggers, and macroeconomic catalysts. Executing a trade before all three of these pillars converge exposes your capital to a mathematically low-edge environment. You are effectively guessing in the chop. To demonstrate how this alignment is achieved, we are examining a specific case study from the morning of May 7, 2026, focusing strictly on the MNQ asset today. Take a look at this initial chart. The pre-market price action here is raw and messy. This jagged price line fluctuates wildly, moving entirely sideways without establishing any clear narrative direction. We are going to reverse engineer the exact May 7th trade frame by frame. By building the setup from scratch, you will see exactly how this sequential filtering process works in real time. High-probability momentum trading is never about predicting the future. It is about systematically layering data points over the raw price action until a clear, actionable narrative reveals itself. The first step in our sequential filter is establishing the technical bias. We need mathematical permission to look for a trade in a specific direction.
We determine this bias by applying two specific moving averages, the 21-period and the 100-period exponential moving averages, or EMAs. Watch this chart as we overlay those two indicators. We are looking for the exact moment the faster 21-period EMA crosses above the slower 100-period EMA, which happens exactly here. In our system, this specific intersection is defined as the golden cross. This cross triggers a rigid, non-negotiable rule. It establishes our medium-term bullish permission. As we darken the area below the moving averages, it visually reinforces that our focus is strictly upward. From the second this cross occurs, the trader must mentally shift into a strict longs-only posture. Every short setup, no matter how tempting, is entirely ignored. Securing a technical bias is your first line of defense. It ensures you are never trading against the dominant institutional momentum. With our upward bias locked in, we move to the second step, defining the structural trigger to locate a precise entry boundary. Returning to the chart, we map the 28,805 price level. This hard line snaps in to represent the pre-market high, or PMH, established earlier in the session. Notice how the price action interacts with this level. The PMH acts as a heavy ceiling, actively confining the early morning trades to a tight range-bound space. Reclaiming this PMH level serves as our structural go signal. Breaking that resistance proves that buyers have absorbed the early morning supply. The territory above the 28,805 level is what we call blue sky. There is no immediate overhead resistance, allowing the asset to enter a rapid phase of active price discovery. A bullish technical bias is completely useless on its own, unless it is accompanied by a clear structural break. That break is what provides the necessary path of least resistance. We now have our bias and our structural line in the sand, but breaking strong resistance requires external energy, bringing us to our final pillar, macroeconomic catalysts. Looking at the chart, the position build occurs strictly within the 28,775 to 28,780 range, securely under our resistance line as the clock ticks closer to the top of the hour. That top of the hour is the 10 a.m. Eastern Time data window, a critical period we refer to as the kill zone, where institutional algorithms react to incoming economic metrics. At precisely 10 a.m., the first macro catalyst drops. Lower than expected construction spending data hits the wires, driving immediate volume into the market. Concurrently, the government reports soft factory orders, printing lower than the consensus estimates. And right alongside these reports, a sustained secondary drop in global oil prices adds further macroeconomic context.
Success requires reading the market's reaction to data, as raw figures alone do not dictate direction. This specific interpretation of soft economic metrics and lower energy costs provided the green light for the extension. To institutional buyers, this specific macro backdrop acted as a clear green light for aggressive, risk-on equity positioning. This explains why identical structural setups often fail at 9:45 a.m. but violently succeed at 10 a.m. At 9:45, they lack the injection of macroeconomic fuel required to actually overpower institutional resistance. Once the 28,805 level breaks, the momentum extension carries the price rapidly upward, reaching its absolute peak at the 28,855 level. This breakdown panel calculates the theoretical maximum of the trade, capturing the full 75-point move on 3 MNQ contracts at $2 per point equals a $450 payout. Firmly chasing that mathematical maximum in live markets violates professional prop firm realities. You cannot expect to catch the absolute top of a spike. Instead, this execution chart details the protocol we actually use, tiered scaling. The mechanics of scaling dictate that we lock in partial profits at predetermined interval targets as the extension builds, rather than holding everything until the momentum stops. Executing those partial exits along the way results in a final realized gain of $290 for this specific case study. Sacrificing absolute mathematical maximums through tiered scaling is mandatory. It eliminates house money risk and strictly adheres to institutional drawdown rules, protecting your capital from sudden reversals. This master view of the final chart confirms the perfect alignment. We see the technical bias provided by the EMAs, the structural trigger of the pre-market high, and the macro fuel injected right at the 10 a.m. mark. Notice the exact time duration of this entire sequence. The trade was identified, executed, and entirely closed within the very first hour of the New York session. We define this early completion state as reaching day done status. Day done operates as a heavy psychological defense mechanism. This status secures a win for the trader's mindset, preventing the overtrading cycles that typically erode daily gain. Achieving this status early protects traders from the urge to sit at the screens and overtrade in the lower probability, choppy environments that dominate the afternoon. It completely cuts off the give-back cycle, the pattern that routinely destroys retail accounts when traders fail to walk away after capturing a clean, high-edge extension. Do not chase the market out of a fear of missing out. Once you hit your extension targets, close the platform. You must wait patiently for the sequential filter to fully build and confirm the structural break before putting a single dollar of capital at risk. Aligning the triad of momentum removes the guesswork. This framework grounds day trading in disciplined, repeatable risk management, replacing the impulse of